Hello and welcome to the Off the Grid Investing Podcast. This is episode 7. I'm your co-host, Grayson Lupus, here with co-host Jameson Manwaring.
Hey.
And our guest for the day, Nick Heth. Is it Heth?
Heth, yep.
Heth. I want to say Heath, like a Heath bar for some reason.
It's like it's spelled. Yeah.
Yeah. So today we're going to be talking about the real estate market because we have a mortgage broker with us who actually owns Phoenix Mortgage Brokers here in Phoenix, local. So we tried to talk to all sorts of different Phoenix-based businesses on this podcast. And so we have CEO of Neighborhood Ventures, Jameson Manwaring.
Yep. And Nick actually did my mortgage for the house I bought, 6 months ago.
Oh, I didn't even know that.
And so he got it done, with my credit and everything. I don't know how he did it, but
Well, we work with all shapes and sizes. And that's one of our specialties here as a mortgage broker. We're able to work with self-employed individuals.
Yes.
Ones that are just getting started up. I mean, you got to be able to think outside the box, outside the big bank mentality of, does it fit all the boxes? If the answer is no, you need to have creative cap on and think a little bit differently about it.
Yeah, that was my issue was obviously I'm an entrepreneur,
Yep.
have different sources of revenue, different areas. Banks traditionally like to see a W-2
Mm-hmm.
and a job that you've had for 8 years that's going to pay consistently. It
Yep.
makes sense.
Yep.
But yeah, Nick did a great job with my mortgage. And then his office is here at the Grid, along with Neighborhood Ventures and a bunch of other real estate tech related companies that are here. So
Yeah, and that's one thing that we can talk about later. But I want to hear a little bit about your story first. But later, I also want to talk about how entrepreneurs and like self-employed people can get loans, because when I started like my entrepreneurial journey, I was curious, I was like, okay, I'm just gonna house hack, like maybe buy a fourplex, use it just a credit card. But then I was thinking, like, I don't have like a W-2, like I don't have consistent income each month. So I was like curious how I was gonna get that loan. But first, let's talk about your story, how you got to where you're at today, where you started.
Let's see, started a long time ago.
College,
After I graduated college, I graduated University of Minnesota and decided I didn't want to shovel snow the rest of my life. Wanted to see what the sunshine was about. So made my way west. And then, of course, we were kind of finishing a refinance boom in the early 2000s. So got a job with a broker. And then even unbeknownst to me, I didn't even understand maybe what a broker versus a retail bank was. I just knew I was a loan originator. We kind of evolved into a banker or a correspondent model. And I've always thought, as I grew my network, I was able to get more and more business, and thought, if it wasn't for the regulations, I'd have my own brokerage. And so it took until 2018 to realize that the compliance wasn't as scary as everybody had kind of made it out to be after the whole bubble burst.
yeah, the whole mortgage business changed drastically after the 2007 to 2009 mortgage crisis, right? And we can talk a little bit more about that, but regulations came on big time.
Yeah. Everybody blamed, I think, the mortgage broker for doing those subprime loans. I think the Big Short had kind of the scummy mortgage brokers. Hey, we'll get you in, no credit score, no job needed. You get 5 strippers have 50 houses together, and
in fact, the show the guys from New York that were onto it came out to Vegas, I think, and they saw the type of people who are getting these loans for these $600,000-$700,000 houses.
Yeah.
And some of that was true, and some of it was probably a little bit exaggerated. But so you were in the business at that time.
Yeah, absolutely.
So did you see some of that happening?
Absolutely. There was luckily that wasn't really my niche necessarily.
The strippers weren't your niche.
I mean, I tried to make it as much as possible, but no. If you had like the landscaper making $100,000, not every landscaper can make $100,000 and afford an $800,000 house, right? So I did have coworkers who I do recall. One gentleman even came in. It's kind of like, hey, the gig is up, as we were still doing great, and the subprime was starting to go away, and he just had like the writing was on the wall. I'm cooked. My business, my niche is going to be done. I'm gonna go back to selling cars, and that's where he came from. And he kind of had a good run at it, and then he quit, even though his last paycheck was good. he wasn't able to sustain it, but he knew it, and he knew the cycle of it. And that really made me aware that, it is a cycle in this business. It's not going to be sunshine and roses every day.
So what did you do through the mortgage crisis? Were you a mortgage broker then, or?
So yeah, we were still a loan originator at the end of the day, but we were moved to a retail under a bigger branch. More money, had more room to navigate the law, all the new laws that went into place. We had to get licensed, and who could maintain the compliances of it all, right? And now with technology advancing, allows you to be a little guy and still be compliant, and the systems are in place. The technology, the software has become affordable as a one-person shop, and that's how I got started in 2018. Was you can buy over-the-counter, out-of-the-box software systems to stay in compliance and not be worried about being shut down. And I think it also helped that the regulators stopped, chasing after it, right? Like now we're into times are good. Nobody's losing money. Let's let these guys, do better for the consumer. And we were offering, we're able to offer rates that are lower than a big retail branch because we don't have to pay the overhead, the managers, and the extra attorney fees, that come along with the bigger spots.
Yeah, and when we go back to kind of pre-financial crisis, it was a little bit of like Wild West.
Absolutely.
My oldest brother had started a mortgage company, so when I was graduating high school, I went and worked in it. And they were a mortgage broker, which basically meant that they would originate the loans, and then they had relationships with like Countrywide. Remember Countrywide went
fast and easy
out of business. Fast and easy loans, which sounds good if you're trying to get fast food or you're trying to get your car, oil changed. But for a mortgage, fast and easy is kind of a little sounds pretty risky, and ended up being pretty risky.
Very risky.
And then now the regulations came in, and probably a little bit more heavy-handed, definitely originally, to try to remedy that. What do you think were the types of loans that really caused the biggest problem? Were they the low down payment loans, or were they the no doc loans, or what did you see?
Yeah, I think people took advantage of the low doc or no doc loans, right? And then you combine that with little to nothing down. You as I'll call it a Arizona immigrant could go buy a house as a primary residence with zero down, and there was no real oversight about it. So why wouldn't you? When you talk about a house hack, of course you're going to, hey, I can go buy this house with zero down. All I got to do is sign this paper and they give me this house.
I don't have any skin in the game.
No skin in the game. So if push comes to shove, I got to eat or I got to pay this mortgage. Hey, I'm still going to get my stake, and I'm going to let this house go. Then it just created a domino effect where, okay, you're going to, sell that house at, what would it be, 99% of its value, 98. And then the neighbor is going to be like, oh, now I'm in the same boat. I'm going to sell mine for 97%. And it's just a domino effect until you get down to a 50% loss. And you're a young family and you want to upgrade, but you can go rent a house. I think that's one major difference right now in the market is the rents are so much higher and going higher. With your neighborhood ventures, it's a perfect business to be in because the rents are continuing to go up. People want to live in a desirable area. So
the rents are more corresponding going up with a mortgage payment. So there's not kind of this easy out, well, let's just lose the house and go pay rent. It's kind of like
now you lose the house, you pay more in rent. So you're going to hold on to that house with everything you got. Absolutely.
So after college, did you go straight into car sales, you said?
No, I went into mortgages.
Mortgages, and then at what point did you decide?
I've never been into car sales.
Oh, I thought you said
that was
you were joking.
Another guy.
Yeah. No, that was a coworker of mine.
So you've been
who did that? Yeah. So
your whole life.
Yeah, when things got tough, it was great for me because everybody else left, and I think that's what we're going to see right now is a purging. I mean, you can look at the layoffs with. Who's the Better.com, of course, just infamously laid everybody off via Zoom or Skype.
Yeah, that didn't go over real well.
Went over horribly, The trick is everybody's doing that, and I'm not real sure if you work remotely, I don't, that's how you're going to do it. I think that was maybe lost in translation. But at the same time, I think our industry was set to be able to handle $4 trillion in business, and maybe we only do 3 trillion. Well, we're 25% overstaffed at least. And now, I mean, even today, the market's up maybe 0.3% in rate. So
just today.
That's a horrible day. Yeah.
Yeah.
And
it changes day to day that much.
Not usually, but today it did.
Hopefully,
so
your people
here,
have locked their rate last week before today.
Yeah, hopefully they called when I told them to, and locked when I said.
Because if they don't lock it, let's say they're working on a refi or their purchase, and they're thinking it's going to be 3 3/4 or whatever, they don't lock the rate, it can change before they close.
How much like dollar difference is that, like for like a $500,000 house or something, like over time?
Oh,
would that be like
if you amortize, it'd be a huge, an astronomical difference.
But monthly,
really?
But monthly, shoot, I don't even know what the quick math would be.
Well,
it can be significant. An eighth or a quarter probably shouldn't matter, but hey, it'd be like maybe the difference of going out one more time a month or something like that.
Yeah,
so $50 to $100.
They can sometimes move as dramatically, over a course of 60 days, where a house you could afford 60 days ago, now where rates are, you can't afford that anymore because your income
absolutely
has stayed the same, but your payment now is higher and it's the same house. So
absolutely,
we saw the Fed keeping interest rates low to spur economic activity through COVID, which it did. Spurred it a little too much. Now the prices of houses and housing has gone up. And now they're saying, hey, we need to pull back some of this fuel that we put on the fire. And people in the mortgage industry are kind of a little bit pawns in the game because they can't control what rates do. And so, someone who has been in the business, 20 years now, over just 20 years, is a little bit of an anomaly because it is a cyclical industry. But if you can do that, you can build a great business like you have. Because if you have somebody who's good in the business, you're going to go back to them. How did you weather the storm through the great financial crisis? Did you stay in the business? Did you get out for a little while? Or
I stayed in the business, and all of my business has been by referral, right? So if you do a good job for somebody and they had a positive experience, they're going to come back to you. They're going to tell their other friends about them, or about you. One of the things I pride myself on is I never wanted to have you look over your shoulder and think, oh, Nick really ripped me off. So I always align myself with places or companies or products that allowed me to, I don't have to be the lowest rate ever of all time. Better.com tried to be that, and now they're laying everybody off and potentially going out of business.
They're forced to. Their business is so margin thin. There's no room to
a good business model
survive.
Isn't losing money on every deal. It sounds like a horrible idea, right?
Right.
So basically, just was still working my way up. Always live frugally, live beneath your means, and ultimately I got married at the time during that crisis, and we had dual income. So we were able to start a life and continue to go forward, which allowed me to maybe take more risks. Like I was able to start my business with, a job with no salary, with startup costs, with, who knows if Phoenix Mortgage Brokers was going to make it. I was able to say, hey, I'm still gonna be able to go home and eat at night. It definitely helps.
How do you know that if you're cut out for that? Let's say you're in college and you're looking at different options, because that to some people probably sounds like, I don't want to live, that risky where I don't know if I'm gonna.
Oh, sure.
How do you know you were cut out for that? And what are the times where you think, this person, he or she may not be cut out for that type of life?
I think how you live your life, if you budget correctly, and how you spend your money, right? If you're going to spend every dollar paycheck to paycheck, it means you need that paycheck. I think there is a mentality switch when you change the fact of, how much do I get paid per hour? How much is my time worth? Versus how much does this job pay? Then how quickly can I do that job? That's the key. Like, I don't think that you'll ever make, as much money working for somebody else as working for yourself, right? I think what's the entrepreneurial saying where nobody ever worked harder trying to avoid working an 8 to 5. You'll work 80 hours a week instead of 40. And I think anybody who, questions, hey, how much am I getting paid per hour and how many hours do I have to work? That's the wrong mentality. You got to have, how many hours do I get to work? And at the end of the day, can I build a sustainable business? Those are the goals.
So you just have a different mindset.
Yeah.
Going into it. And did you always have that, like when you were younger, or did that just kind of happen as you got into your career?
I think both my parents are entrepreneurs. My dad just sold his hardware store in a small town since 1984.
Wow.
So big congratulations to him.
Yeah.
But I think that's always led me to not be as afraid and not live that lifestyle of, okay, maybe my mom was a teacher and my dad worked at the factory kind of mentality. And, we punch the clock in at 9 and we leave at 5. Yep. My parents worked a ton, right? And hopefully we're, instilling that kind of work ethic on our kids to say, just depends upon what kind of lifestyle you want to live. And I've always known I didn't want to, live a, white picket fence, working a 9 to 5, getting 2 weeks off, or I don't know, 4 weeks off a year.
Yeah.
I don't understand that. It doesn't make sense to me. Yeah. Having an entrepreneurial spirit has always probably been in me.
So how does for like someone who knows nothing about the mortgage industry, which I don't know a lot at all.
Yeah.
How does it work from actually getting a client to completing it? Like what qualifications, like how does the mortgage industry work? And then you're a loan originator. So how do you, then how do they get, like, where's the money come from? Like just very dumb, like.
Oh,
basic,
sure.
Yeah.
So I think the things that a bank looks for, and you as a client or as a potential home buyer, you got to have 4 different things that we're going to like grade you on, right? And that'll help determine the rate. The first thing we always talk about is credit. Do you pay your bills on time is the biggest thing, right? Do you, if I lend you $5, do you pay me back on time? If I lend you 500,000, are you gonna pay me back on time? Your credit score is indicative of your ability just to repay, that debt. It's upon you and, a little bit of us to decide how much credit you're gonna get. But the more you show that you're able to repay, the more you'll be able to get. The second thing would be your income. How are you going to repay this? You go into, you just started up a new company. That seems riskier than, okay, you work, even if it's at Starbucks or Intel, maybe be popular here where, okay, Intel's probably not going to go anywhere. Startups, you never know, but a W-2 with 2 years consistency is going to be huge. That's going to be a good indicator to be like, okay, Noah's been here for 5 years. He seems to be working up his way up the ladder. He keeps a raise every 6 months. I like that. That's a good risk. The third thing would be your down payment. How much money do you have in reserves? Are you coming in with 0 down? Do you want DPA, or do you have 20%? If you have a 20% skin in the game, I know you're not going to default, and you're going to scratch and claw to keep your 20% and keep me being paid as the lender or as the mortgage, right? That's going to be a real big indication of risk there. And then the fourth thing that we look at is what kind of property you're trying to buy. Is it a unique home that just you will like, or is it going to be a single family in a nice neighborhood, with comps, condo or a townhome, with lots of other like kind, properties? Or is it going to be a manufactured, which manufactured homes might be the new first-time homebuyer home, given the price point. The homes have gotten so high so fast that new product might be just that starter home. Let me just get in, prove to you I can make a payment, build some equity, and then move up.
When you say manufactured home, do you mean like are these like the homes that are like flip up the walls and stuff, or like what do you mean?
Kind of like that. Built in a factory, honestly, and able to be moved and then put into place to create that real value. Real estate or real property, I should say, is something that's affixed to the property. A trailer you could literally hook to your car and drive away. Manufactured home is fixed to the property, so it's going to be a lot harder to lift it up and go overnight. If I lend you $500,000 for a mobile home, you might just take it and go for a road trip, and I don't know where you are.
Some of those mobile homes that have been in their lot for 30, 40 years still have the axle underneath. With wheels, and they've just put skirting around them. But if you pull the skirting off, you can just pull that thing right off.
Yeah.
So at what point did you go from I'm guessing that you didn't start your business right away. You worked for someone else.
Oh, of course.
Loans?
Yeah.
And then eventually you switched to owning your own company. When did that switch happen, and like what caused you to switch?
2018 it happened. It just happened to be maybe the perfect timing. I kind of known about the mortgage broker world versus we were in what they call a correspondent, where I worked for a company called Guaranteed Rate, and they would sell off their loans to a Chase, to a Wells Fargo, to a New Res, different servicers, and that's just how the business works. The paper gets traded, right? As a business in that line of work, you say, hey, Chase can't hire every loan originator, in the U.S., but they can create an outlet for a wholesale to say, hey, we'll mark this, I don't know, whatever 3% rate down, let you go sell it for 3.125, and that'll still be better than the Wells Fargo was offering 3.25 rate. So the wholesale channel, just think of it like a spigot. You can turn your rates down to get more business, and you can turn them up to make more profit. And you got to find that balance. With any business, you try to do that, right? How much of whatever widget you're building or creating can you buy? How many properties can Neighborhood Ventures acquire? And what should we charge for the rate?
Right. And so from your position, you look at the different places where you can put that loan and try to get the best rate for the client, right?
So on any given deal, if it's a first-time home buyer or a guy who's got 20 financed homes, everybody's got a different profile, and that's what makes our job so unique and so fun. It's really like putting a puzzle together. First, we take the client, right, the borrower who wants money, and we decide what their profile is, kind of build that up. And then what we're going to do is take that to the market and say, okay, I've got 20 different investors I work with. You're going to be grade A, right down the middle, very vanilla. Okay, who's got the best rate? A 30-year fixed or a 15-year might be what you need. Or in the case of an entrepreneur who's got, hey, you know what? I've got 2019 was a great year. 2020 shut me down. Now I'm back 2021. Might need a more creative set of eyes to look at it and say, okay, I understand what happened. There's still going to be additional risk compared to my W-2 borrower. So now I need to take them to this other investor who has that appetite and still, a favorable rate versus going and renting.
And in that situation, the borrower probably needs to put in more of a down payment.
Yep.
They need to have maybe some more reserves.
Yep.
Going back to those 4 important things that they look at, it kind of has to still weigh out.
Still weighs out, and just think of it as layers of risk, right? Like no down payment is a layer of risk. Only 1 year at the job is a layer of risk. Low credit score is a layer of risk. What you want to do is what we try to do is eliminate those layers and say, listen, we do have a high credit score. Maybe we have a lower down payment, but the guy's only 22 years old. So we can still fit him into this box. And that's what's going to be really interesting over the next few months, if not few years, is Fannie Mae, Freddie Mac. They're going to create new products for first-time home buyers. They're going to recognize that the market is a little bit off right now. The pendulum has swung the other way, where only the rich can get richer. If you can buy a home, you can buy 10 homes, versus, hey, if I can't afford one home, when will I ever be able to afford it? It just keeps going further out of my sight.
Do you think it'll get easier for first-time home buyers to purchase a home in the future?
Hopefully, yeah. I mean,
it's probably really hard for them right now.
Yeah, I think it's going to be hard to get a deal accepted. Low down payments are tough. If I'm a seller and I got 2 different offers, they're all the same price to me, and I got one with 3.5% down using an FHA program versus 20% down, or a cash, heaven forbid. Gosh, I'm going to take as much down as possible, because it's just less likely that, hey, if the interest rates just jumped up 0.5%, can I still afford this home? As a seller, you don't know that they've already locked their rate, or doing a lock and shop rate, or if they've got the debt to income cushion in there to afford a 0.5 point higher rate. What you would hate to do is accept the offer, find out 5 days later, oh, I never locked the rate. Now I can't afford it. Now as a seller, I got to go back to the market, have another open house, do the whole process.
That's one thing that I haven't even really considered with the housing market right now, is that the first-time home buyers, to your point, they're in the worst position to get to land some of these homes, maybe even if they can afford it with two incomes, but they don't have 20 or 25% down. They've worked hard to save 5% down, but they're least likely to be an accepted offer compared to the other people on the market. And you're right. What ends up happening is in Washington, which dictates the policy of Fannie Mae, Freddie Mac, who are not government entities, but government-sponsored entities. Washington will probably start pushing, and they should, to make it a little bit more of a level playing field for these first-time buyers. And, and not to get political, but they also pushed that earlier in the early 2000s. And, President Bush was saying he wanted every American to own a home. And so that kind of opened the floodgates, and that's partly what caused the great financial crisis, because they they made it too easy for people to buy homes. So
I think that pendulum keeps swinging one way or the other. It doesn't matter if it's too tight or too loose, too tough or too easy. Yeah, it just keeps swinging. Once you, I think, understand those cycles just exist, can help make you better investment decisions.
One thing I've always been confused about is like, why is it better for a seller to have someone purchase their home with like all cash or even like 20% down? Because in my head, I think that they get the same amount of money either way. Like if they're selling their home for $500,000, someone puts 20% down, that's just going to the bank and the bank's paying them back, right? So why is that more attractive for a seller to have someone with more down or all cash rather than like the FHA loan?
Just more certainty. If I'm a seller and I have a contract, and what we're seeing right now in order to even that playing field is buyers are waiving their inspection contingencies or their appraisal contingencies, maybe their financing contingencies. I can never truly recommend that as a great idea, because you lose, your ability to negotiate once you get into the house and home inspection, and you realize, you're looking at the money pit, but you've got $20,000 hard. You can't walk away from that either, until you really get in and kick the tires on the house. You don't know for sure if maybe this is the house for you. That's why most contracts have in Arizona a 10-day inspection period. So if I have a cash buyer who waives all contingencies, they're not going to have that same financing contingency. They may have a 5-day home inspection period or something like that. But I mean, I would rather have somebody have their cash in their hand than say, oh wait, hold on, I gotta go, ask mom or dad for the $5 I owe you and bring it back out. So,
and that's what a bidding war will create
absolutely
is the seller is holding all of the leverage, and they're just going to say, I got 3 offers that are above asking price. I will take the cash. Typically they can close sooner. And there's no
underwriting timelines, no appraisal. You don't need an appraisal. You can just say, hey, we'll close in 10 days or faster the wire can get there.
And FHA loans can be painful when it comes to the inspection. So if FHA loan, which is a government sponsored loan, or VA loan,
certain conditions,
they come in and they have to make sure that the home has certain level of insulation and all these other little things that a conventional loan isn't a requirement. And maybe some of that's changed since what my experience, but those loans, the government backed loans, are harder to get through.
Yeah, I would definitely say they're not as easy. Certainly cash is there's no level of scrutiny, right? Like you're buying this house and that's what it is. FHA and VA have definitely become more friendly. In fact, I think VA loans are the best loans out there. But it also depends upon the house that you're buying or selling too, right? If you've got holes in the wall, don't take a government sponsored loan, right? But if everything in the house generally works, then FHA, VA loans are going to be just fine. They're going to be great. In fact, I don't know if there's anybody better to lend to than a veteran, somebody who's served our country. You thank you for your service, but no, I'm not going to sell you my house. I think that's just like the biggest slap in the face. But there are certain requirements that they have on the homes, right? I mean, everything just needs to basically work, right? You don't want this veteran to come into your house and then have to spend, $10,000 on a new AC unit, right? those are some general things that just should exist. So.
Where in a market right now, the seller gets to pick, and in a typical market, these folks getting FHA or VA loans are just as good as anybody because they're going to buy the house, and that's what you want. You want someone who's going to buy the house. But now, the pendulum has swung.
So how do mortgage brokers make money? I know there's like an origination fee.
Sure.
And so it's like 1% to 2% or something like that. And then how do you make money on like the discrepancy between the interest rates that you sell it at? Or I don't even understand how they make money.
Yeah, ultimately we can get paid two different ways. One is to charge you as the borrower, right? And it is negotiable. It's a little bit different with everybody else. Phoenix Mortgage Brokers, our fee structure is going to be lower than, I would say, 99% of the street, right? So you're going to come to me and you're going to know that you're going to get a better deal than you will when you go to a retail store, Wells Fargo, Bank of America,
and that
Chase.
cost is generally on the borrower.
So the other way we get paid is by the wholesaler that sends us, that's going to lend you the money, right? So we're going to shop your loan. We're going to get paid the same from the wholesale lender, no matter where we take it. It's just who's got the best price that day. So when we deliver that loan, they pay us an origination fee. I think that's probably the best way to say it.
And it's like 1% to 2% of the purchase of the loan.
It's going to depend upon the loan size, and right now our margins are lower than ever, so we're going to be less than 2%. Definitely no more than 1.5.
Yeah. So yeah, like real estate agents, even though it isn't a fixed price, it generally is accepted that real estate agents will charge like 6% to sell your house, usually 3% to the buyer's agent, 3% to the seller's agent.
Yep.
And so the mortgage side of the transaction is usually a couple percent. Is that fair?
Yeah. Depending upon where you're going to go, I mean, you could see origination. It really is. It's hard to say what the actual amount paid by Chase or Wells Fargo. They're going to pay their guys less, but that's why their names are on the top of buildings, because they keep the most, right? Us as originators, we're usually upfront about what we get paid. Most of our originator or wholesalers that we're set up with pay a 1.5% fee. So
let's talk about. Okay, let's talk about the business a little bit in general and how Phoenix Mortgage Brokers work. So, did you started with just you, or did you start with like a partner? And then how soon did you bring people on? And are those people like employees? Are they like hourly? Or are they other brokers doing deals underneath you? Or
yeah, so I started a Phoenix Mortgage Brokers as myself, as a one-man shop, but I named it Phoenix Mortgage Brokers, so I couldn't be just the one only broker.
You didn't want to be Nick Broker.
Nick the Broker, yeah. So then I've added on basically some friends of mine that I've worked with in the past quickly came on board and said, hey, yeah, we'd like to kind of hang my shingle with you. You've gotten the licenses, you've gotten the company started. My what I pay is higher than what you're going to earn at Chase Bank, for instance, as long as you originate yourself. So there are some minimums that we have to stay compliant as an employer, but all of my guys are on commission, right? So they could earn $1 million next year, they could earn $0. It depends on how much they want to work, how efficiently they work, how good their lead sources are.
And so have you gone from a larger team over the last couple of years to a smaller team? What are the numbers looking like now compared to last year?
Yeah, we've got, there's 8 of us total for the company. We've had as much as 10, had a few people go off on their own and do their own thing. And so we're 8 people strong now. We have moved to more of a work from home model, right? Yep. With interest rates up, business is going to be down. And so, everything we can do to stay lean and mean to make sure that we can offer our clients the lowest rates is kind of our goal or our model.
And where are you guys getting most of your business from? Like maybe you said your most referrals are some of your guys. Are they like doing any sort of like marketing, or are they just doing it themselves? Like, are they all referrals? Is that how the business usually works?
The way that we've set up is to be by referral. for the most part. I don't think anybody in our team buys leads. You know, the more people you can talk to, the more people you can network. If you do a good job for somebody, you know, we say, hey, if you can refer us to your friends and family, you know, that's the biggest compliment we can get. And once you go through us and have us price you out, you're going to realize what a deal we are. And then, yeah, why wouldn't you tell, you know, your friends and family about us? Yeah. So that's a very organic way to do things. I think I realized that that's pretty rare, or more rare, I think, in this digital world. Everybody wants to have the most Instagram followers, and that's just not something that I've had to pursue or wanted to. More of a, hey, I'm going to do good by you, you do good by me mentality. And
you're old school.
Yeah. I feel old now. Yeah.
And where do you see the business going from here? Are you looking to grow it? Are you trying to keep it the same size? Because it's probably like supporting a lifestyle that you like right now.
Yeah.
Like I don't know. Are you looking to get?
Yeah, I'm not trying to be the biggest broker in the world. Honestly, where we're at right now is a good spot. You know, we want to be relevant. When you get a pre-qualification that says Phoenix Mortgage Brokers, we want to know that, you know, we want you to know that that deal is going to close, and you know, faster, better, and cheaper than anybody else. But at the same time, like, I'm not looking to add more people. More people is more human resources and more headaches, right? You know, as a one man, I can only answer so many phone calls a day, right? So I'd rather focus on the current clients that we have, our current, you know, realtor partners, financial advisors that we have, and just do a good job for them. I'm not sure if we can grow much more without suffering that work product loss, right? If I'm not able to answer my calls or get back to you in a timely manner, I'm going to lose my business. So there's a natural, probably elevation to where we're at that I think is good. So.
Yeah, finding that sweet spot of not losing the quality and the customer detail to attention to detail, but finding the sweet spot so you can have a business that that can grow and that can sustain where you want it to be. What do you think about the housing market? You see a lot of appraisals and a lot of purchases. Would you buy a house right now, and why or why not?
I think the market's going to continue to go up. I think there's too many people moving here. I think Arizona's too economically friendly for other entrepreneurs, right? Just getting started is easier to do here, you know, than a California, than a Seattle, than a Portland. So I do feel like the market is going to go up. Luckily, I already own my house, right? I would buy now, as long as I could afford the mortgage payment, right? I think you got to start somewhere, and if you realize that, you know, if you're a young person and maybe you get a roommate or two or three, you know, buy a bigger house than you would normally, you know, maximize that as best you can, but then fill it with your friends who could then pay you, you know, below market rent, but for you would be paying your mortgage. So you could wake up 3-4 years from now and have a great investment to then where you can move on to maybe your next house. Building that equity, I think, is key, you know, versus saving up. I think it's just so hard. It would take you so long, and trying to time the market. You'll never know the market, you know, bottom until it's gone. You'll never know the top until it's gone. I think there's a chart that basically shows real estate goes up and to the right, you know, eventually at all times, right? Proven till today.
Do you think there will be another crash like 2007 ever again, or do you think?
I mean, you can't say there won't, but the way we lend now, ask Jameson how hard it is to get a regular loan. We don't have that same no questions asked, zero down loan. The best we have are showing 12 months of consistent bank income, and you still have a 20 to 25% down requirement for that. So maybe if their income, you know, going back to those four things, maybe if their income isn't the best, they're going to make up for it with their down payment or their reserves. So the market, the way it was in 2006 to 2008, is just so different than the regulations and due diligence that we do even today.
Is there anything that you see that causes you a little bit of concern, you know, that let's just say things do turn south? with the real estate market,
Sure.
and then you look back and go, I kind of noticed that, and is there anything that kind of stands out to you?
I mean, I think offering as much as people are and waiving all these contingencies is got to be scary, right? You have to know, and that's something that's happening right now, is that we are seeing appraisals come in lower than the purchase price because you're having to outbid that cash buyer. Everybody else who may be able to make up those other differences are stretching themselves. So I think people,
and you have to come out of pocket with that difference, right?
Straight cash, yeah. And there's no making that up. You're not borrowing it from another source and able to double borrow. So I would be, I would just say, aware that you're paying overvalue, but that's the price of it. A seat for the Suns game is going to be higher when they're good, but you want to go, and it doesn't matter that it's going to be $500 a ticket, even though retail value is $200.
Yeah, gas prices are $6-7, but the freeway is still packed.
Yeah. It's supply and demand, and as a capitalist, I'm all about, the more people can charge, the better, right? If you're a seller, great. I want people to have a bidding war over my house. But as a buyer, you just need to be aware that, you're buying at the all-time high. And the reason you're buying at an all-time high today is because tomorrow is going to be even higher. When the rates jump 0.5%, that mortgage payment that you got today at $399 is going to be so much better than 4.5. And just look at that personal payment. Are you able to rent or to buy for that same dollar amount? And you just have to take that into consideration. If you're a young family with kids, like, you need the 3-4 bedroom house with 2 bathrooms. You can't live in a studio apartment. Like, that's just not realistic. If you have dogs, you're going to have to get a townhome or a single family. You're not going to be able to live in a condo or apartment for the rest of your life. So those are the things that are going to move the market, and just have the mindset that you're going to stay there, until you can afford the next, or until you can move again.
I have sort of a 2-part question,
Yeah.
kind of last question. So it's, what advice would you give to a college student, sort of entrepreneurial college student? And the second piece is, what industries do you think that a college student should pursue in 2022? Like, if they're a brand new entrepreneur, like they want to be an entrepreneur, they want to be a business owner, they don't know what industry to go into, and they want some advice on maybe some mindset or investing, maybe budgeting, things like that.
Budgeting mindset, you've got to spend less than you make, and don't care about the car you drive or the clothes you wear, right? Just that margin of living is so important. I've seen a lot of people, I see a lot of people's financials, right? And you can see the person who drives the BMW or the Tesla, the fancy car, but at the end of the day, he only has $100 left over.
Always.
Like, you can't have that.
That's always that guy.
Yeah.
The guy and the guy you think has nothing in the bank.
Oh yeah.
They have the money in the bank.
Absolutely. Yeah, the millionaire next door, right? Like so, however much money you make, save more, right? Always pay yourself first. You got to do that. That's got to be your mentality. But then going back, I think, to the first question, you definitely have to be tech savvy, as non-online as I am, and more old school. I still know how to use a computer, right?
And softwares and CRMs.
And software, CRMs, yeah. And then the second thing is, you got to, kind of when we first started, is you have to want to work. Like, you have to want to outwork everybody else, right? So you can't be worried about vacations and where you're taking your next Instagram photo. Say, hey, like, can I find a job where my earning opportunity is unlimited? That would be the most attractive thing for me. Mm-hmm. And then work that job and work for free if you needed to. Do an internship. Take the lowest level paying job as you can get. Just get your foot in the door, and then prove yourself once you get there. Don't let anybody outwork you. And then, as you're doing right now, ask people questions. Learn from people who hopefully have done even better than myself. Dealing with and then I would say also, chase things that are hard. Find out what nobody else wants to do and go do that, because that's what's going to pay you the most. I think the current environment, and you can tell me if I'm wrong, but the trades tradespeople are busy as can be.
Yeah.
I mean, contractors, plumbers, electricians are able to name their price at this moment because everybody wanted to go get a 4-year degree and go to college, which is a great thing. But then it's like, what are you going to do once you're out?
Yeah.
Once you're one of 100 people or 1,000 people applying for that same job, maybe go take the job that nobody else wants to do, learn how to do it better than everybody else, then be able to charge what nobody else can charge.